if you're considering buying a home, you might be wondering if this is a good time to take the plunge, or how do you even define a good time when it comes to today's market condition. On the Money Show today, we get your confusion on this cleared, and we will analyze what is the right time for you to financially buy a house. Let's welcome on board Harsh Roongta, founder of Fee Only Investment Advisor LLP. Harsh, good evening and welcome to the show. We all dream of having our own place, our own investment, which is also the home that they want to live in. But then how do you analyze and how do you understand that you are really ready to buy a home, or maybe the first investment that you've thought about your entire life, which is to buy a house for yourself? You are totally ready for it financially, emotionally, and obviously by financially, it's just not the buying part, it's also the repaying part that you need to get sorted with. So what is that particular time in your life, or that feeling in your life when you feel confident to do this?
So I think to be able to answer that, the key point that we should keep in mind that, buying your own home, the home that you stay in, imparts a sense of security. You feel secure, you feel stable when you buy your own home. And that feeling of stability and security has an economic value, which all these rent versus buy calculators really do not take into account, because it is very difficult to estimate that value. It is also a social signaling tool. You're signaling to the rest of the society that, see, I not only have the amount for the down payment, but I am also confident of my prospects, income earning prospects in the future. And that is why I have taken a long-term loan. It's a very important social signaling tool. In fact, families that don't own their own home might have difficulty in the Indian setup, for their children getting married, etc. So it's a very important social signaling tool. But the issue with the social signaling tool, or using buying a home as a social signaling tool, is that security should be real. That sense of security should be real. And when is that sense of security real? Obviously, when you have the money for the down payment such that you can make the down payment enough so that the EMI on the loan should not exceed 35% of your regular monthly income. When that is there, at least you feel secure that the ability to repay is also there. And when I say 35%, that includes all loans. So if you have already a car loan, that further brings down the amount of home loan that you can get, or any other loan if you have. So very clearly, buying your own home makes sense. The social signal has a lot of strength, provided, as I said, you have enough down payment and you just need to take enough loan, including all loans, such that the EMI does not exceed 35%. One other important
And I want to stress on, so one thing I want to stress on, and which you also just mentioned, the social signaling part, because what happens is a lot of times, and we all are conditioned that way also, maybe being in India, that's a very major part of our upbringing also, that having your own house, having a house on your name that you've bought, it signifies, or it denotes financial independence or financial freedom. What is the backdrop of this thought, and why now this particular thing needs to change?
So I think we must hark back. I mean, this is not an era that people have seen, that very few people owned houses. I'm talking of the 60s or the 70s or the 80s. The era of owning your own house, middle classes owning their own house. And earlier in the 70s, 80s, and even maybe till the beginning of 90s, even when people bought the house, they actually bought it late in their lives. By the time they were 50, 55, home loans were not so easily available. So it is the arrival of home loan credit with the pioneering HDFC, and then a lot of other banks joining them. Uh, that has allowed this to become a movement. So earlier, it used to be a big sort of announcement of arrival in life that heralded the buying of a house. And I think that continues to be part of our social setup. It will take time to change. As today's young generation, when they grow up, they may not have the same feelings. And when the second generation grows up, those who have been born just now, maybe 20 years from now, it will stop being as significant a social signal as it is today. Okay, and today it is less of a social signal than it was just 15 years ago. So I think it's a continuum that is changing. Just to have one more point on the affordability and the sense of security, I think you must be having some outlook on how long you are going to be staying in the city where you are buying the home. Uh, because if you the transaction costs on buying are very high, stamp duties are high, registration costs are high, brokerages are high, so all that adds up to about 7-8%, for which no value is available when you sell. So unless you are committed to the city for 5 years at least, I don't think you should buy a home. And the second big important factor is that social signaling works only if you stay in a home. So basically, buy a home in an area that you would really want to live in. Don't just people buy a home in a far away, far flung location. I'm talking, say, Bombay, you buy it on the outskirts and then stay on rent, near your office, etc. I think that has a much weaker social signaling. It does not have, in fact, any social signaling value at all. So I think understanding this could sort of give a rough idea as to when you should buy, when you should feel secure enough. And if you do not give value to the social signaling, then take a decision basis, pure economic considerations alone.
Along with this, okay, these are the factors that you might want to consider before taking a home loan and before taking this entire dream of yours into reality. But then, even the repayment part needs to be decided before you want to go for this. That is also crucial, because a lot of time what people do is that they already have too many financial liabilities or responsibilities, and on top of that, just for the social signaling or the status that they want to maintain the society, they just want to buy a house of their own. So is it very important to plan your finances? I mean, obviously that's the most crucial aspect of taking such a huge loan which you want to pay off for like more than 20 years maybe. But then the repayment part also needs to get activated from the time you're giving your first installment.
Oh, absolutely. So as I said, if the repayment on a normal basis, okay, most people end up prepaying home loans, but even on a normal basis, you should be that total EMI, whether of the home loan or any other loan you have, should not exceed 35%. Also, after you make the down payment, maybe you will are left with no assets at all. And maybe that's not such a good thing. But even if you are okay with no assets, you should have at least enough assets for your 6 months expense, including the EMI. So that if there is a loss of job or there is a downturn in the business or the practice that you are doing, you will still have the ability or to repay the home loan. Please remember, there is no worse social signaling than your house being repossessed. Okay, that is the worst possible form of social signaling. In fact, it's a huge social signal of distress, and you cannot avoid showing it. So, if you will remember, jewelry people don't sell because that's considered, a signal of distress. But that you can do secretly; nobody else will come to know. Whereas, if your house is repossessed because you can't pay a loan, or you have to sell it yourself and then go and stay in a smaller house, that clearly is a signal of distress. So one should think about that if one values social signals.
All right. Now, talking about people who want to buy second homes, I mean, would you recommend that? I mean, obviously, if one feels financially stable to go for this decision, they should, if they can. But again, social signaling for your second home or maybe having a property just for investment, does it make sense?
So I think investments are completely different. I
Totally.
don't think investments also might have social signaling. It's not that it will not have, but I doubt people take second homes for social signaling unless they plan for it. I mean, so there are big businessmen who will take a farmhouse outside. They will invite, uh, government officers, bureaucrats, their influential friends, etc. Uh, that obviously has a social signaling value. But otherwise, the second home is basically a luxury. So if your budget allows for it, take it. Taking a second home on a loan, I would not really favor that. It is a luxury. And obviously, it is something that you ought to do if you can afford to do it. Uh, I would be hesitant to consider a loan, to recommend taking a loan to buy a second home.
That will be all. Thank you so much, Harsh, for being on the show and helping our viewers in helping them understand as to when is the right time for them to go for their first home. Thank you so much.
Thank you. Thank you, Kavita.
We move on. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Once you are done buying a house, the next most important thing is to ensure that your home sweet home is safe and secure over years. And one way to do that is to buy home insurance. It is a form of property insurance and one of the several types of general insurance products. Let's understand more about this home insurance with Vivek Chaturvedi, CMO and Head of Direct Sales, Digit Insurance. Vivek, good evening and welcome to the show. Let's break this down. What exactly is home insurance and what type of covers are we talking about? Because is it just the structure of the house, or we are also talking about whatever you've collected in the house in terms of your decor and everything else?
Yeah, so home insurance covers one, the structure of the house. And when we talk about structure, so typically people have done their interior also. So that interior work also comes under structure. Then there is a content part of it. Content could be the appliances you have, furniture. Then there is another valuable part. So there is general content and valuable content. In valuable content, people can insure jewelry, people can insure, say, if they have artifacts, somebody has bought expensive painting, that can also be explored. So that is not all. There are other things also. Say if somebody comes in your house and there is an injury to the person and the person sues you. So in that scenario also there is a public liability cover which can be taken, which will be covered. If there is a damage to the structure, that is also covered. So typically when we think about home insurance, we think about structure and usually damage due to, say, a flood or terrorism or earthquake. But home insurance is comprehensive. It covers many more things which may happen on a higher frequency versus some of the natural disasters where the frequency is quite less.
So when we go out to take a home insurance plan, Vivek, what exactly, I mean, are we talking about a comprehensive plan over here, or we are just talking about ensuring the structure, or everything comes under this particular scheme?
So, Kavita, what happens is it depends upon if, say, somebody is renting a house, then ensuring the structure may not be the concern. It's the content which is there in the house may become more important for the person. And people can take only content only product also. If you are the owner of the house and you are staying in the house, you would want to take both. You may want to take a comprehensive cover which covers both the content and structure slash fixtures of the house. So both the things are possible. People can choose what they want to choose depending upon what is the requirement of the person.
And so what exactly is the claim procedure behind this in all type of covers, if we have to talk about?
Yeah. So let me talk about instances when home insurance becomes important for the people, and then I will talk about the claim side. So typically, a home insurance, as I said, it covers the structure or the fixtures. And when we say fixtures, it's all the interior work people have done. So people would have put false ceiling. Somebody would have created a nice walk-in closet. All that thing is covered, and the one damage that can happen to a house is due to fire. And I'm not talking about like some of the things which we have also seen in news, like there could be a gas leakage. Because of that, there is a damage to the house, or you could have a short circuit. And typically what we have seen, that out of 100 fire claims, 80% of the claims are typically due to short circuit, and that is more common. And if there is a fire due to these kind of things also, and there is a damage to the house, the home insurance covers for that. Along with that, flood becomes one more coverage. And typically, say I stay in Bangalore, and people in Bangalore will say there is no flood, but there is inundation. So last year we had Bangalore floods, where typically in there was like a 3 hour 4 hour rain, and then the part of Bangalore was flooded, and there were a lot of societies where the water seeped in. So that is inundation, and damage due to inundation is also covered. And what we are seeing is inundation is becoming far more common, especially in large cities where there is a close housing society, and all the constructions have happened, and the water is not able to move around when there is a large shower in the area. Then there is a damage due to earthquake, that is covered. Terrorism, if there is something happened because of terrorism, that is covered. So that is one part in terms of damage that can happen. Some of the other things which can lead to a damage is, say, if you have a bungalow, and it is on the road, and there is a vehicle which smashes the wall, so that part is also covered. So if you see from a home insurance perspective, anything that can happen to the house, that is covered. Along with that, then you can get coverages like burglary cover. So in case there is a burglary, and somebody takes away the content which has been insured, that part can be covered. Uh, there is accidental damage to the electronic item. So everybody has TVs in the house. Now imagine, the TV falls, or something hits the TV and the TV breaks. So the accidental damage is also covered in the add-ons that are available in home insurance. Coming to the claim side, typically what happens is that if the claim is less than 1 lakh rupees, most of the time surveyors are not appointed, and they are settled digitally. In our case, we basically have a video digital process where we do a video survey, where somebody sitting in the office will ask the owner or the insured person to shoot a video of the house, and basis that we settle. In case if the amount is more than 1 lakh rupees, or if it's a total loss, or if it is a flood loss, then we may appoint a surveyor who will go there and study the damage, and basis that we will make the payment.
This entire thing that you just explained is applicable on an apartment or on an independent house, or that also varies?
So all pakka constructions are covered. So it could be independent house, it could be an apartment. I will give you an example, like say in case of independent house, if something happens to the house, or apartment, even expenses related to, say, engineer expenses are required, or architect expenses are required to rebuild the house. Those are also covered in home insurance. So the list of things which are covered in home insurance are quite large. Basically, whatever you can think can go wrong in the house, usually that are covered through home insurance. I will give you one more example. Say in most of the apartment, those fire sprinklers are there. Now, in case if there is if there is fire, or there is then the sprinklers usually spray a lot of water, and it damages all the false ceilings and everything. So if the repair cost that is required to rebuild that false ceiling and other things, and even case if there is a damage to, say, appliances also, those are also covered under home insurance.
Since there are so many contents of coverage under one home insurance policy, do we get to decide or select as to what kind of coverage we want? Maybe we want something against natural calamities, we want something for burglary, something for fire, or you think it just, or the fact is that it just comes in one package. You buy one home insurance policy and this is the kind of coverage you get, which covers everything.
Yes, so if you see the Grah Rakshak policy, which was introduced by IRDA, that is a very standard cover. It covers both structure and also it has a component which covers the content. Say if somebody is buying, and there is a limit to content. So if somebody is buying sum insured of say 50 lakhs, there is a 10% 10% sum insured is also there for content. Now that is automatically covered. So 5 lakh rupees of contents are automatically covered. But somebody may say that, hey, I have more content. Maybe I have more appliances or I have say valuables like jewelries and other things which needs to be covered. Then there is a choice of increasing the amount of content that needs to be covered. Along with that, in case if somebody has built something additional to the house, which somebody wants to insure, that can also be covered. Even I will tell you, like if in home, especially in the standalone houses, if somebody has put a solar panel, or even if somebody has dug a well, if there is a damage to that, that is also covered by home insurance.
A lot of coverage, Vivek, but then let's also talk about the kind of sum assured that you might want to go for and the kind of premium that you might have to pay.
Yes, so typically the way the sum insured is calculated, one needs to check the carpet area of the house and multiply it with the construction cost in that market. And that with that the person will arrive on the sum insured for the structure and fixture. You would be surprised hearing the pricing for this. It would be less. The pricing is less than maybe a tea that we take. So if I have to talk about structure plus or the coverages that I talked about, like something happens to house because of fire, because of flood, or water inundation, or earthquake, or terrorism. Typically, the pricing will come out to around 20 rupees for 1 lakh rupees of coverage. So if somebody has a house which is like our carpet area into cost of construction comes to 50 lakhs, for a year, you would be spending around 1,000 rupees. So it's not an expensive product. Then if one wants to add more coverages, like say burglary needs to be added, burglary can also be added. Typically, a burglary will cost another 20 rupees per lakh rupees of content. So typically, if there is a 50 lakh rupees of house, the content would be around 5 lakhs or 10 lakhs. So if burglary needs to be added, one will add another maybe 200 rupees. So it is not costly, like within roughly around 2,000 rupees or 2,500 rupees, you can actually get most of the coverages also within for the year. The other option also is that you can take for multi-years. So it's not only restricted to 1 year. One has an option to take this product up to 10 years. And we have, like Digit has launched another product where we are giving an option for a customer to opt up to 20 years also. And when somebody is taking a multi-year policy, we understand that real estate prices go up and cost of construction also goes up. So every year, without the impact in premium, the sum insured increases by 10%.
Right, so for all those people who really think buying a home insurance is like adding an extra expense, this is the explanation for you in a very elaborate way that it is a feature-packed product and also cost-effective. Thank you so much, Vivek, for being on the show and helping our viewers with that today.
Thanks, Kavita.
And welcome back. You're watching The Money Show with me, Kavita Thapliyal. Recently, SEBI data shows that 23% of the actively managed regular schemes have underperformed their respective benchmark by a margin of at least 1.25% in 10 years compared to 10% actively managed direct schemes as on Feb 2023. So why are regular schemes underperforming, and should you then opt for a direct plan vis-a-vis regular plan? Let's understand all of this with Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisor India. Kaustubh, good evening and welcome to the show. So what exactly are we talking about? You know, almost 40% actively managed regular plans have outperformed or delivered benchmark returns.
Yep. Hi, Kavita, and thanks for having me on the show. And I think it's a very important discussion. And this is a debate that's been, perhaps being spoken about for the last few years in the Indian market, the whole active versus passive sort of investing outlook. And, they're both sides to the story, right? So let me just break it down. So firstly, the data obviously shows that over a longer time period, significant chunk of actively managed schemes. So if you put direct and regular together, probably about 55% of the schemes are beating the benchmark or a 10-year sort of period. But also what's important to understand is, while the benchmark is a construct, as an investor, when you have to think of a passive option, it would be fair to compare that against an investable peer, right? So we tend to think of the benchmark as a benchmark, for the lack of a better word. But remember, if you have to make an investment into a benchmark, it's typically an index fund or an ETF, and there are obviously costs associated with that too. So if I look at the breakdown of the data that obviously SEBI's put forth, it would probably be worthwhile looking at combination of funds that have outperformed obviously just the pure benchmark, but also up to about 1.25% of underperformance. Because remember, when I look at even say index funds, and obviously there are not too many index funds with a 10-year track record, but typically on your broader equity indices, you've had some of these funds, you would see that the underperformance versus the benchmark has been anywhere between 0.5% to 1.5%, right? So if I compare an actively managed fund with an index fund, I think the percentage would obviously move up over a 10-year period. But if you look at the more recent history, and we'll talk about the reasons for that, the percentage of funds actually beating the benchmark has come down, which is something which is kind of led to this debate of active versus passive.
So, Kaustubh, what exactly does it mean? Are investors more conscious about what kind of plans they want to go for, which could lead to this also? But then, what does it mean?
Yeah, absolutely. So I think, so when you think about investing, right? So obviously you're looking at, you're looking at, kind of making a return which is to meet your goals, but also to just benchmark yourself against what is the broader market doing, right? That's where the concept of benchmarking is really coming. And if you are getting into an actively managed scheme, you would expect that, the scheme should, through the active management with the professional fund manager, outperform a standard benchmark that it is tracking, right? But remember, there are costs involved. And like I spoke about that, it's first useful to compare that against an index fund rather than purely the benchmark. And B, there are costs associated, right? So like the SEBI study has shown that typically direct plans have, greater percentage of outperformance than regular plans. That's intuitive. Obviously, direct plans are, if I think about equity funds, are cheaper anywhere between 50 basis to maybe almost 1% than the regular plans. There is obviously a cost, of brokerage and all of those costs that are incurred. So all of these leads to a little bit of a drag on the performance. But that said, if I just put into context what's happened over the last few years, right? It's been a little bit of a different market. It's been a polarized market. So if I just jog back in history and see the way some of these marquee benchmarks performed, especially in the period of 2017 to 19, the index heavyweights, right, really added to the large part of the index movement over that period of time. So it was a very, very polarized market. And in fact, some of the index heavyweights, were very close to 10% or are at 10% and excess of that. So obviously, fund managers either had limited exposure or perhaps no exposure in some of these cases because they fundamentally weren't very convinced about some of those stocks, or had an underweight, or couldn't add because of regulatory norms. So all of that did lead to this polarization returns, which did significantly add, I would say, a reasonable amount of underperformance to an actively managed fund versus the benchmark. Obviously, that's, we wouldn't expect this on an ongoing basis. And, things should normalize as we've seen over the longer term track record. And B, very importantly, right, there are, and this is a study that we've done on performance of actively managed funds, and it's an eye opener, and I think all investors should pay heed to it. When we look at the performance of track record over the last 10 years and broke it down into monthly performance, and all we did was look at the funds that had outperformed the benchmark, right, over the last 10 years, and put the best months of performance versus relative to the benchmark on top and in a descending order. And then we looked at how many of those best months of performance actually contributed to the entire outperformance of the fund versus the benchmark, right? On an average, it is 6 months out of 120 months, right? So 5% of the time. And those 6 months can come at any point of time. So you as an investor, if you're not invested in that particular fund during those good 6 months, you would have actually, even if the fund outperformed the benchmark, which obviously we're seeing is getting harder to do, it would have, you as an investor, you would have actually underperformed the benchmark. So I think that's the other behavioral lesson for investors to know and acknowledge, that you can't time your investments. We talk about not timing the markets. You can't even time investments in an actively managed strategy. You need to identify good actively managed strategies and stay invested in them across a market cycle and just be patient, even if they're underperforming in the recent times. And I think that's a very important, sort of lesson that investors should take away from this study.
Hence, we also seeing the consultation paper where SEBI proposes performance-linked TER for active funds also. But then, Kaustubh, let's move on because we have our viewers waiting to ask their portfolio questions to you. But before that, if in case you're watching our show and you want to send us your query, you can WhatsApp it on our number, which is 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. All right, so we move on and okay, so we are going to take Ullas Babu's question from Kuwait, and he's 43 years old and he says he's a moderate investor. Gold tenure is 10 years and he's holding one mutual fund in his portfolio, invested 5 lakh in Parag Parikh Flexi Cap Fund, and he wants to add one more Flexi Cap and lump sum investment of 5 lakh in that. So what would be that one more suggestion? And again, the time horizon for that investment will also be 10 years.
Sure. So I think firstly, it's great that Ullas Babu is already making an investment and he's identified a fantastic strategy to, take exposure through a flexi cap fund, which not only gives him exposure through, large, mid and small cap stocks, but also international diversification as this fund has been buying into international stocks. Obviously, given the caps right now, the allocation has been coming down, but it's still a pretty healthy allocation to international stocks, right? I would think, given his existing holding in the Parag Parikh Flexi Cap, there's, I would recommend that Ullas can look at another Flexi Cap fund like the Kotak Flexi Cap. So again, a very, very well managed strategy, by Harsha Upadhyay. And the beautiful part of, between the two funds, right? We talk about diversification. The similarity of the portfolios is quite limited. So when I say quite limited, it's only about 19-20% of similar kind of holdings within the two portfolios. So, we've seen that Parag Parikh in the more recent, there's been a little bit of underperformance, and that's completely understandable. Last year was not a great year for obviously, some of the US tech names, while now it's, it's been catching up, but US markets relatively had underperformed at that point of time, right? So when you think about diversification, here's a case where, you can buy into two funds, albeit at the surface, they may look like funds from the same category, have very, very different portfolios, different styles of management. So by adding the Kotak Flexi Cap, which, like I said, is an extremely well managed, very proficient manager, Ullas can get a very well diversified portfolio within his construct of just two portfolio funds, will kind of help him, go a long way in achieving his investment goals.
We don't have him on the phone line, or else we could have asked more questions on his behalf. But then we move on. We have Vikram from Bangalore on phone line with us. Vikram, hi, good evening. How are you?
Hi, good evening, madam. I'm good. How are you?
I'm doing good, thank you. And thank you so much for sending us your query. Let me confirm, you have Navi Nifty 50 Index Fund, you have Kotak Equity Opportunities, Parag Parikh Flexi Cap, Tata Small Cap.
Yes.
All right. And this is, how much SIP did you say?
Sorry, can you come again?
You are going to invest for 20 years and you want to step up 10% yes. also.
Yes, yes. Every year 10% step up, and it's for 20 years.
All right. What's the corpus that you're looking at?
2 CR.
All right. Cost of around 29,000-30,000 investment right now. Also, I wanted to ask one question on Navi Nifty 50 Index. You have a lot of other AMCs offering you same category fund. Why would you go for a smaller AMC for this particular category? Cost of?
Yeah, along with that lower expense ratio.
Right.
because of these two reasons.
Right. I mean, what's the expert view on that, Kaustuv?
Yeah, sure. So let me, maybe address the portfolio question first before I get a very specific question on the index fund, right? So, I, if I look at the overall construct, and I think what Vikram has very nicely outlined is, he's got a good 20-year runway to building his corpus, and very rightly he intends to step up the SIPs by 10%. I would encourage him, at least 10, if not more, as sort of the financial situation permits. But when I think about the construct of his portfolio, I think broadly good. And I'll address the Navi question in a minute. But given that he has a 20-year horizon, I think there is a propensity that you can take on a little more small and mid-cap exposure. If I look at the existing breakdown of the investments, almost about 75% currently is kind of allocated towards large caps, given that the Nifty 50 index fund is a significant part of the SIP of the portfolio, right? And then you have a little bit in a large and mid cap fund and a flexi cap fund and a small cap, right? We can maybe increase the mid cap exposure a little bit, and you could probably just add to one of the existing large and mid cap or flexi cap funds, which will in a way kind of increase your mid cap exposure. So take away some of your SIP amounts, maybe about 3,000 rupees at the current values from the index fund, and move it to a Kotak Equity Opportunities or the Parag Parikh Flexi Cap, which will just kind of move you towards a little more aggressive positioning, so to speak. But given that there's a long time horizon, I don't see that as an issue in the portfolio. That's definitely one of the recommendations that I would make. Now, specifically about obviously this index fund versus the others. So to be honest, we are very, very agnostic, between the size of the fund or the fund house, because this is clearly obviously a passively managed strategy. So so the things that an investor needs to check for, and I think one of the things obviously Vikram very clearly outlined, is expense ratio. Obviously that's important because the cheaper it is, the lesser it's going to eat into sort of the tracking difference. I think the other thing that's also important to keep in mind and evaluate, and we'll as this fund seasons, we'll get a better idea, is how good is how low is the tracking error and the tracking difference of this strategy, and in terms of how well is it able to execute and replicate the index on an ongoing basis. And there are several other index funds which might be a little more expensive, but have extremely low tracking errors attributed to them, and with long track records. So I mean, that's just I'm just playing the devil's advocate that you might be getting 20-30 basis points cheaper in expenses, but it's also important to look at tracking errors. This fund is obviously still building a longer term track record, so that's the only one thing that I would keep an eye on. Otherwise, I don't see an issue as long as they continue to do a good job in terms of managing it very close to the index, right? So I think that's broadly the construct that I would recommend Vikram to do in terms of just that tweak to the portfolio. We already spoke about stepping up his SIP needs at least by 10%. And about the goal that he spoke about, and just doing very quick back of the envelope math, that he's currently doing about 29,000 rupees SIPs per month,
right?
And obviously step it up. I think he'll comfortably reach his goal of 2 crores. In fact, he'll far exceed that over a 20-year period. Yeah.
Quickly, we move on to our next viewer, Rahul Yadav from Indore. Hi, Rahul. Good evening.
Good evening, ma'am.
Okay, so you have Parag Parikh Flexi Cap, Murasset Mid Cap, Axis Small Cap in your portfolio, and you have 1 lakh investment lump sum in Canara Robeco Small Cap and PGI Mid Cap. Why specifically only Mid Cap and Small Cap in your portfolio, and then 1 Flexi Cap?
Yes, ma'am.
Rahul?
Yes, ma'am. Yes, ma'am. Yes, ma'am. I want to review my portfolio. Is this good, or should I change my portfolio?
You will be invested for how long, and what is the total amount of SIP?
Ma'am, I'm investing in these funds for 2 years, and I'm looking for 30 years more.
All right. Kaustuv?
Yeah. So firstly, I mean, Rahul, great that you have a 30-year horizon. It's a very rare thing to hear. So very pleased to that you're acknowledging that you need to be invested in the markets really to make sort of long-term returns, especially in equities. My only advice to you, and when I look at the construct of your portfolio, and like Kavita pointed out or asked you, that there's a significant tilt towards mid and small caps in your portfolio. Obviously, you have 1 flexi cap which has a large cap bias. But when I just look at the underlying construct of the 3 SIPs that you're running right now, it's almost a 33 sort of portfolio with only 33% in large caps and the remaining 2/3 of the portfolio, which is towards mid and small cap stocks, from the funds that you hold, right? Now, my advice, while obviously mid and small caps are great long-term sort of, but any portfolio construct should still, to prevent too much excess volatility, because we've seen periods where mid and small caps have gone through significant drawdowns and have stayed depressed for a long period of time. And that's why we recommend that ideally the core holding of your portfolio, irrespective of how long your investment horizon, should always comprise of, kind of the bedrock, the large cap sort of stocks. And that's why I would recommend that take this up to at least, about 60% in large caps, and 40% is actually a very healthy number in terms of mid and small cap exposure in your portfolio, which will then kind of help you, and 30 years, like I said, is going to add a lot of compounding to your portfolio. The other thing, like we were telling the other viewer, step up your SIPs, right? So today you're doing about, I think about 3,000 each in 3 funds. Try to aggressively step that up, 10, 15, 20%, as much as your financial situation permits. Do that year on year, because, the earlier you start with larger sort of sums of money, and that's how it can grow over that long period of time. Obviously, time's your friend here. And like I said, when you're rejigging the portfolio, maybe reduce a little bit of the mid and small cap exposure, add to either a large cap index fund, or, there are a couple of good actively managed funds from the large cap space, like the Mira Large Cap, the Birla Frontline. You can pick one of these to make the exposure more rounded rather than being very, very staggered towards mid and small caps.
All right, I think that will be all. Thank you so much, Rahul, for sending us your query. And with that, it's a wrap. Thank you so much, Kaustubh, for being on the show, helping our viewers with their financial portfolio today. And but then I'm going to leave you with our WhatsApp number and email ID, where you can send us your portfolio queries, and we will get that answered by our expert live on the show. Thank you so much for watching. Goodbye.